And moving on now, crude oil prices at the international market seem to have dropped further below $70 a barrel. Nigeria's main source of revenue is crude oil, and it's the supplier of foreign exchange to the country. Well, a drop in the price of crude oil production, they say, will impact negatively on the fiscal position of the country. With 5 weeks steady decline in crude oil price, economists at the FSDH Merchant Bank Limited say this may impact Nigeria's economy in the short to medium term perspective. The slide in oil price will affect macroeconomic instability in the exchange rate as well as inflation rate. I have in the studio with me Head Research FSDH Merchant Bank Ayo Akikomi and Chief Economist Vetiva Capital Management Limited Michael Famuroti joins me via Skype. Good afternoon, gentlemen, and thank you for joining us in Business Nigeria.
Thank you for having me.
Pleasure to be here.
All right, let's begin with Michael. There's been a sharp pullback in oil prices over the last 5 weeks, dropping for 4-year highs last month amid rising output from key producers. There's the broad sell-off in global markets and no doubt a deteriorating outlook for oil demand. The question back home really is, how does this impact us? Some people are saying Nigeria's budget for 2019 would be highly threatening, pushing us into more debts. How do you react to this? I'm just going to direct that same question to my guest in the studio. How exactly, what are your thoughts as regards this?
Thank you very much for having me. I think we issued a note this Monday at FXTH Research, and we titled it, "What if crude oil prices continue to drop?" We examined the possible implications on the Nigerian economy.
That's right.
The crude oil is important to Nigeria from two major areas. Number one, in terms of the provision of foreign exchange earnings for Nigeria, and number two, in terms of revenue for the government. And so, if we have a reduction, significant reduction, a drop in oil price, what it means is that we are going to have a drop in supply of foreign exchange. Now, crude oil accounts for over 80% on the average in the last 5 years of Nigerians' export. And there is no, in the short term, there is no alternative to that. So what you are going to have is a significant reduction in the supply of foreign exchange to Nigeria, which may likely lead to, if it is protracted, may likely lead to a foreign currency problem in the face of even the rising demand that we begin to see, or have been noticing in the foreign exchange market. And that may lead to depreciation or even devaluation of the currency. That's number one. Number two, and of course we have the negative impact of that on, on the economy. We will have high price, we will have maybe incidents or even rise in non-performing loans for banks. We will have companies may not be able to have access to imported input to manufacture their products, and therefore the economy may likely slow down. And if care is not taken, it may lead to the problem we had in 2004, 2006. Number two, in terms of the revenue, it accounts for a significant portion of federal government revenue also. And a reduction in that also will mean that government will not be able to have access to revenue to fund their operations. And that also have negative impact on the economy.
Let's take this to Michael Famuroti. Just about 2 months ago, the global oil price was at about over $80 per barrel, the highest in 4 years. Many Nigerians then protested that not much impact has been felt on the economy, especially it tallies with a rise in the consumer price index. So why should we worry then when the price begins to fall?
Actually, I think my colleague in the studio has done a very good job of explaining why the oil price fall is of significant importance, especially in 2019. And for me, the key variable to look at here is external reserves. They have fallen significantly as well over the last 6 months. And because of how the CBN calculates its reserves, it's a moving average, so we probably haven't even seen the full extent of the fall. We know that they're issuing a $2.8 billion Eurobond soon, and that will help support reserves. But if you look at the fundamentals, it does look like there's going to be sustained pressure on the FX market, and that is why there has been so much concern about whether the CBN has the ammo it needs to actually defend the currency. That said, I'll just point out the importance of anchoring, really, because oil prices are currently at around $69 a barrel. They began this year around $65 a barrel, and even at that time, that price was celebrated as a positive. I remember that most expectations from the IMF, EIA, and so on hovered between $55 and $60 for 2018. So we have actually been spoiled silly this year in terms of the level of oil prices, and it is no surprise that we're seeing them retreat back towards more reasonable levels.
Mr. Akikomi, the top crude exporters like Saudi Arabia, has now begun to raise alarm over supply outpacing consumption. They are afraid that there could be a repeat of the glut that caused price crash in 2014. Recall that the oil price around 2012 was about $125 per barrel, and it fell below $30 by 2016. Already OPEC is talking about the need to cut oil supply by 1 million barrels per day next year in order to balance the market. How relevant is this at this time?
I think it's very relevant. Over the weekend we heard news about the plan of by Saudi Arabia to cut production next year. I mean, starting from actually December by about 1 million barrels per day.
That's right.
That may likely help to stabilize the global market, because there was a discussion about the possibility of Saudi Arabia increasing production. America was trying to lobby them to increase production, just to douse the negative impact of the sanction on Iran on the global economy, global oil market. And again, to back up with that is the fact that the demand for crude next year is not really very impressive because of the weak, global economic, growth expectation. Right. But if Saudi Arabia is able to cut production by about 1 million barrels per day, I think it will go a long way to stabilize the price and the global oil market, and then so that we don't go into an area whereby we have a glut.
Mr. Farmer wrote it, the U.S. President Donald Trump has taken credit for the steady fall in oil price, even as it continues now to put pressure on OPEC not to cut supply in order to prop up the market. There's also the subsisting U.S. sanction on Iran. How far can the drop in oil price go, in your opinion?
Calling the oil market is a fool's game, but I do think that there's more room to fall. President Trump is a very interesting man and can take credit for anything. But indeed, despite the sanctions on Iran, he has actually contributed to the bearish sentiment towards oil prices. I agree that Saudi Arabia leading OPEC can help stabilize prices in the short run. In the medium term, I'm less optimistic about OPEC's ability to sustain prices. And I think 2018 has been a learning experience for the group, because if you look at US oil production, at the end of 2017, the US was producing about 9.8 million barrels a day. 9 months later, or 10 months later, they are producing 11.5 million barrels a day. So they've added nearly 2 million barrels a day, and that has effectively been subsidized by OPEC pushing up the oil price, right? So what it does is create a cat and mouse game where OPEC continues trying to cut production to prop up near-term prices, and that boosts US production as they get more efficient. So I think we need a longer-term solution, and I think that the reality of the oil market is that OPEC is actually waning in terms of its capacity to influence the long-term trajectory of oil prices.
Mr. Akiwumi, at some point in 2014, they said the world was floating on oil. If there is more supply than demand, I mean, the layman understands it this way, that there is enough oil to go around. Why should anyone be afraid of that? Okay, so I think I agree with the large extent with his contribution. But one thing we need to also understand is this. There is an organized market, OPEC, the cartel, which, if you look at the global supply outside from non-OPEC countries, it's barely about 60% of the global oil demand. Mm-hmm. And therefore, outside OPEC, there is no, the non-OPEC members cannot meet global demand for oil. And so the organized OPEC countries will always be relevant in short to medium term. In fact, the forecast up to 2023 shows that they will be relevant in the global oil market. And the fact that they can come together to agree means that they can influence the global oil price. That's right. To a large extent. Coming now to Nigeria, when there is a glut, I mean, we've seen this early in early 82, 83, 84, all right, where that led to currency problem. In 2014, 2015, we saw this and how it led to currency problems in Nigeria. Right. And the implication of this on the economy is negative. And that is the reason why people are worried about us. But I think, like we read in our report in FXTH research, that it's like you said, is a learning experience for Nigeria in particular, the need for us to diversify our revenue base and the sources of our foreign exchange earnings to Nigeria in such a way that we are not just, because the way it is, we are just at the receiving end. We don't have control over the production because we belong to a cartel. We don't have control over the price, and therefore, if we do not do something to ensure that Nigerian economy, in terms of revenue and the foreign exchange earning, is insulated against the volatility in the global oil market, we will continue to have problems. Let's wrap this up very quickly. Mr. Famaruti, you said earlier that OPEC is winning in its ability to restore price and, of course, ensure that there's a quick price recovery. But what lessons are Nigeria learning at such a time like this? What precisely should Nigeria be doing?
Again, I think he's covered it really, because it's a case of shifting our focus. Well, we have actually shifted our focus to non-oil sources, but nothing much has materialized from it. I don't expect any change in the oil dynamics. Nigeria is going to continue to be a price taker. It's going to continue to be subject to the OPEC quota. It's unlikely to pass the PIB anytime soon, and because we aren't going to see significant investment in the sector, right? So that dynamic isn't going to change. So the reality is just, like he said, can we actually quickly diversify our FX and government revenues away from oil, just to ensure that we are resilient, because the peril of the oil market is that it is a boom and bust market. And we learn that every decade, but unfortunately, we haven't put that learning experience into practice. Apparently. Chief Economist, Vertiva Capital Management Limited, Marco Famaruti, thank you for joining us today on Business Nigeria. I also have with me in the studio the head research FSDH Merchant Bank, Ayo Akiwumi. Thank you so much for your time. Thank you for having me.